you never know when you're going to get a black swan. And that's, when you ask me how long, I'll tell you, it'll last until we get a black swan. And what's a black swan? It's an event we're not expecting to happen, but these black swans come along every now and then. It could be a war, it could be an earthquake in California, it could be a pandemic, it could be a recession, it could be civil unrest, it could be political turmoil. We don't know what these black swans might be, but there could be something comes along which makes people nervous. And if they're nervous, they stop investing in the stock market. And then someone says, I'll sell that nice fund I bought because I'd rather have it in the house next door or that condo in New York or whatever he decides to buy. And little by little, the prices start to slip. And then suddenly there's a rout because all the machines are selling it all at the same time. And they don't care. They have to sell because people are redeeming their units in the fund.
This is a trend that the West perhaps can no longer be in control of. There is not enough physical supply to play this game. You can only manipulate a market over an extended period of time by pushing it in the direction that it is going now. The total money supply, M2, in the United States, is up 14 times since 1980, 14 times, yet silver is 60% of its high. Do you see a problem in any of this? This is all manipulation, and it's ending right here in front of us. You can see it ending.
Hello, ladies and gentlemen. You're watching Silver News Daily, the #1 place on YouTube for you to get all of the best silver news. In today's video, I'll be breaking down some insight and analysis from Clive Thompson and explaining to you why I believe the price of silver is ridiculously undervalued and could explode at any point, even reaching as high as $1,000. Now, before we get into this crazy prediction of mine, how about hitting that subscribe button and getting the notification bell on so you don't miss a video? Well, I'll start this off by taking a closer look at the silver chart today and see what's been going on with silver this month and hopefully come out with a better understanding of how things could go next month. You can see the price was fairly stagnant following a small rally at the start of the month, then beginning this dramatic drop around the 17th to the 22nd, where there was a steady and notable decline of 8% in the silver price. Following that, things seemed like they began to improve and stabilize, but silver being silver, and one more surprise left for us with a massive 6% drop in just 22 hours between the 24th and the 25th. After the significant low on the 25th, we can see a recovery phase starting, with the price gradually climbing back up. By the end of the month, silver shows signs of stabilization and even a slight upward trend, but not as extreme as the past week. It then began a healthy uptrend that left the price at $28.58 at time of recording. I did some more research into the matter and found a couple news articles you might find interesting. First, we have an article from Kinesis Money giving a brief forecast of what's coming in August for silver. Silver demand weathers weak data. Silver has made marginal gains over the last month, despite benefiting somewhat from the easier rate environment that has supported gold, but leaving the gold/silver ratio above 82. The weak economic momentum noted in the previous forecast has continued, with weak manufacturing PMI being registered in the Eurozone, the US, Japan, and China. The weaker-than-expected Q2 China GDP print was particularly troubling and prompted a surprise token rate cut from the People's Bank of China, PBOC. Overall, the data suggests net positive economic surprises in the Eurozone are at a 7-month low. The global economy at a 12-month low in the U.S. has posted a small recovery from a near 2-year low. The weak picture has bolstered the case for rate cuts later in the year. We noted in last month's forecast that silver investment demand had appeared to be resilient in the face of disappointing performance, and this seems to have continued in recent weeks. Although slowing, aggregate physical silver ETF flows remain positive month on month. The most recent commitments of traders report from the CFTC suggests that speculative silver futures positions have been at the highest level since February 2020. While it is far too early to suggest that silver has entered a new investment paradigm, it does seem that its trading dynamic is evolving as investors seek out uncorrelated returns from a range of alternative assets. Silver's recent marginal gains, despite a favorable rate environment, underscore its resilience and potential. The gold/silver ratio above 82 suggests silver is undervalued relative to gold. Weak economic momentum globally, especially disappointing manufacturing PMI and China's GDP, increases the likelihood of rate cuts, which typically boost precious metal prices. Investment demand for silver remains strong, with positive physical ETF flows and high speculative futures positions. This evolving trading dynamic shows investors are seeking uncorrelated returns, setting the stage for silver's dramatic rise. These combined factors, economic instability, potential rate cuts, undervaluation, and robust investment demand, suggest silver could reach $1,000 in a flash before anyone even has time to react. Now let's get a word from Clive Thompson, who is a highly experienced wealth management professional with a 4 to 7 year career. He began in the UK in 1975, moved to the Cayman Islands and Switzerland, and eventually became a private banker at Coutts & Co. After Coutts & Co.'s wealth management division was acquired by Union Bancaire Privée up in 2015. Clyde served as managing director until his retirement in 2022. He is an active investor in global equities and various tangible assets, maintaining daily discussions on wealth management and investment strategies despite being retired.
Carry trade, in simple terms, is when a bank or a borrower or a hedge fund borrows one currency at a low interest rate and buys the bonds of another currency paying a much higher rate. So in the case of the yen carry trade, it would be typically a Japanese bank who would be borrowing Japanese yen from the Bank of Japan, where the interest rates were negative until very, very recently. So they'd be borrowing money at a negative rate. They'd convert that money to US dollars and buy US treasuries, which until very recently were yielding about, well, they still are, about 4.25 at the moment. At one point, they could have got 5%. So if they were paying minus 0.1 for their borrowings and earning, let's call it 5% for simplicity, they'd be earning a net 5.1, which is the negative cost that the bank that they're borrowing from the Japanese central bank, plus the 5% they're getting on the US treasuries. Now, that's a very profitable trade as such. But of course, if you're a bank, you don't want to expose yourself to too much risks. So you're likely to hedge your foreign currency exposure, that is your US dollar exposure, back to Japanese yen. So for those who don't know about the cost of hedging is always equal to the difference between the two short-term interest rates. So up until very recently, up until a year or so ago, 2 years ago, the short-term interest rate in the United States was about, let's call it 1 or 2%. In fact, it was 0.25% at one point, going back not too many years ago, 2 years ago. So we'll call it 1% for simplicity. And the short-term rate in Japanese yen was minus 0.1 for simplicity. So the cost of hedging was, at one point, the 0.25% that the dollar short-term rate was, and the minus 0.25% or minus 1% on Japanese yen. So it was costing you about 0.5% or 1% to hedge your position. Meanwhile, back then they were earning 2.5%, 3% on the American government bonds. So they had a clear return, a positive return on the American government bonds of 2 or 3%, and they were paying a hedging cost to protect themselves against the fall in the dollar of perhaps, let's call it 1% for simplicity. So all in all, it was a profitable trade because the interest they're earning on their bonds was greater than their cost of hedging.
Clive Thompson discusses the concept of the yen carry trade, a financial strategy where banks or hedge funds borrow Japanese yen at very low or even negative interest rates to purchase U.S. treasuries with higher returns. This trade, while historically profitable due to the significant difference in interest rates between Japan and the U.S., involves certain risks. To mitigate these risks, banks often hedge their currency exposure, which incurs additional costs. Recently, the dynamics of this trade have shifted. U.S. interest rates have risen substantially, leading to a less favorable environment for the yen carry trade. The cost of hedging has increased, and the yield on U.S. treasuries has decreased relative to the cost of hedging, making this trade less profitable or even unprofitable. This change in profitability is prompting Japanese banks and other investors to consider unwinding their positions, potentially leading to a significant sell-off of U.S. Treasuries. This situation is particularly relevant to the price of silver because the unwinding of these positions can have broad implications for global financial markets. As these large positions are unwound, it could lead to increased volatility in the bond market, affecting the overall confidence in fiat currencies and traditional financial instruments. Historically, during times of financial instability and uncertainty, investors flock to precious metals like silver as a safe haven. Given this backdrop, the potential for silver to surge in value becomes more plausible. If a large-scale sell-off of U.S. Treasuries occurs, the resulting market turmoil could drive investors towards silver, pushing its price upward. Additionally, if the unwinding of these carry trades leads to a devaluation of the U.S. dollar, commodities priced in dollars, such as silver, would naturally increase in value as well. Next, Clive Thompson discusses the recent changes in interest rates and how they have affected the profitability of the yen carry trade, leading Japanese banks to reconsider their investment strategies. Let's hear more about how these shifts are influencing the financial markets and what it means for the future of U.S. Treasuries and silver prices.
And the reason it's changed is that US interest rates over the last year and a half, 2 years, have risen to they're currently 5.25% to 5.5%. They're coming down, actually. I think they're, I haven't got it in front of me, but it's probably about 4.8% at the moment, anticipating a fall on 3 months. And the interest rate at the short end on the Japanese yen has gone up. So what does that mean a little bit? So that means that if we go back to the, let's say, 5.25%, you've got 5.25% minus the, let's call it 0.25% on Japanese yen, costing you around 5% to hedge your dollar position. But what are your dollar bonds yielding at the moment? Well, they're yielding about 4.2%. So they're yielding less than the 5% cost of hedging the currency. So they're losing 0.8. But not only that, the yield on Japanese 10-year bonds has risen to over 1% now. So not only are they losing money on the dollar position, if they were to go back into Japanese yen and put it in 10-year Japanese bonds, they'd be earning over 1%. So we've got a difference of they're losing about 1% on the hedging cost and could be gaining 1% on Japanese bonds. So they're about 2% out of the money. So what does that mean? It means that the Japanese banks which have done this, and they've done it really big time across the board, are likely to be thinking about unwinding those positions. Now, it will take a year or two because the amounts involved are pretty stupendous. I think there was one bank announced a few weeks ago that they're going to unwind their position for exactly that reason. They're losing money. And I think their position was around 60, or the amount they said they would unwind was around $67 billion. Now, they didn't specifically say it was treasuries. It could be bonds of any kind, but the assumption is that the most part it'll be US treasuries. But if you replicate that across several banks, I looked up about 4 or 5 Japanese banks that I could find just to see how much they got in foreign bonds. The total between those 4 or 5 banks was about $500 billion. And of course, I wasn't looking at the Ministry of Finance in Japan, who've got a big position, or the Japanese central bank. I was looking at commercial banks. But if you replicate that across many banks, and also there'll be non-Japanese investors who've done that as well, like hedge funds, and they're all of those now will be hurting. And the dilemma they've got is, do we wait and see if American interest rates go down so our trade becomes profitable and we don't unwind anything, or do we start to unwind it? Well, the longer that the American interest rates have remained high, the more it's starting to make the pips squeak. And I think that what's going to happen over the next year or two is those positions will be unwound and the pure Japanese investors will be going back into the 10-year Japanese bond to earn more, which does mean there could be quite a bit of selling of US treasuries coming over the next year and a half, 2 years, I would say. Now, can the market absorb that? Yes, it can. But it's I suppose, yet another sign that the number of potential owners of American government bonds isn't going to be as great going forwards as it has been in the past. And that doesn't exactly help the US Treasury when it's trying to borrow more and more money to fund an ever-growing deficit.
In the recent clip featuring Clive Thompson, he delves into the intricacies of global financial trends and their impact on various markets, including precious metals like silver. Thompson explains that U.S. interest rates have risen significantly over the past couple of years, currently sitting around 5.25% to 5.5%. This increase has made the yen carry trade less profitable for investors who borrowed Japanese yen at low interest rates to invest in higher-yielding U.S. treasuries. The interest rate on the short end of the Japanese yen has also risen, exacerbating this issue. Thompson highlights that Japanese banks are now facing a situation where their dollar bonds yield about 4.2%, which is less than the cost of hedging these positions against currency fluctuations, leading to a net loss. Additionally, Japanese 10-year bonds now offer over 1% yield, making them a more attractive option compared to U.S. Treasuries when factoring in hedging costs. As a result, Japanese banks and other investors who had heavily invested in U.S. Treasuries are likely to start unwinding their positions. This process, involving the potential sell-off of hundreds of billions of dollars in U.S. Treasuries, could span over the next year or two, reducing the number of buyers for these bonds and putting additional pressure on the U.S. Treasury market, which is already grappling with a growing deficit. This situation ties directly to the potential surge in silver prices. The unwinding of the yen carry trade and the subsequent sell-off of U.S. Treasuries can lead to increased market volatility and instability. As investors seek safer havens during such times, precious metals like silver become more attractive due to their intrinsic value and historical role as a store of wealth. A weaker dollar resulting from the sell-off makes silver cheaper for investors holding other currencies, driving up demand. Additionally, in times of financial uncertainty and potential inflation, investors flock to precious metals to hedge against the erosion of purchasing power, further boosting silver's appeal. Thompson also points out that gold and silver mining companies have underperformed over the last decade. Despite the rise in silver and gold prices, these stocks have lagged behind. This underperformance is attributed to investors becoming disillusioned with these companies, which were overpriced in the past, and instead moving their money into more lucrative sectors. However, Thompson suggests that this trend may reverse soon due to a wave of mergers and acquisitions in the mining industry. Large mining companies are now in a prime position to acquire smaller, cash-strapped competitors with significant gold and silver reserves. These acquisitions are attractive because, despite the rise in gold and silver prices, the mining stocks have not increased proportionately, providing an opportunity for substantial returns on investment. As gold and silver prices continue to rise, these smaller mining companies become more valuable, especially those with significant reserves that are becoming viable to mine at current prices. This trend could lead to increased consolidation in the mining industry, with larger companies snapping up these undervalued assets to boost their reserves. This consolidation is likely to support the overall rise in precious metal prices, including silver, as mining companies work to increase production to meet growing demand. In summary, Thompson's insights provide a clear link between the current financial dynamics and the potential surge in silver prices. The unwinding of the yen carry trade, market instability, and strategic acquisitions in the mining sector all point towards a bullish future for silver, potentially driving its price to $1,000 per ounce.
I think the reason they've underperformed for the last decade or more, and it's been a very long period, in fact, if you look back over about 11 or 12 years, gold and silver miners are all down from that level of 10 or 11 years ago, and silver and gold are both up. I think the reason is that people have become quite disillusioned with gold and silver mining companies, which probably were a bit overpriced back then. And the rest of the stock market has been rising like a rocket, and people have been withdrawing money from their certainly last couple of years anyway, from the rather stale and boring gold and silver mining companies, which were really doing nothing. The prices weren't going up. And they've said, I'm going to buy something which is actually moving. And we all know the kind of things which are moving. So the money is flowing into the hot stocks and the ones which are moving up. And that might well continue. But I'm going to tell you a reason why, even if it does continue, I think the gold and silver stocks will start to rise in the near term. And that reason is mergers and acquisitions. If you're a large gold mining company, there's never been a better time to buy one of your competitors, one of your smaller competitors, one of your cash-strapped competitors who've got lots of gold or lots of silver in the ground, but don't have the cash to pull it out. And if you can buy a competitor who's somewhere within easy reach of your existing mines, it makes the logistics of moving equipment around much easier. And why is it attractive? Well, it's attractive because gold and silver prices are both up a lot over the last year and a half, 2 years. But the mining stocks they moved up, but nothing like the gold and silver price. So you're getting a lot more bang for your buck if you buy one of your competitors now than you would have done a year or 2 years ago. And the other factor is, as the gold and silver prices rise, it means that these junior gold miners who don't have the cash to do much mining, they do some, can't get the extra gold. The gold which is in the ground suddenly becomes viable. It wasn't viable at, let's say, $1,600 an ounce. It was perhaps only just viable at $2,000 an ounce, but at $2,400 an ounce is very viable. So these smaller mining companies with a lot of gold, a lot of silver in the ground, or the potential for it, are becoming rapidly a lot more valuable as the gold becomes viable to get out of the ground. But the share prices haven't moved enough, or they're moving up a bit, but hardly moved. So the large mining companies are going to be looking at this. They've got to be looking at it and saying, now is the best time to snap up reserves and increase our potential reserves. And I'm not going to say the names of specific companies here, but I was looking at one very large, very well-known, it's in the top 10 anyway, let's say, mining company, who says it in words of one syllable in their annual report, that over the years, they've been increasing their reserves. They have far more reserves today than they had 10 years ago, and they plan to keep doing that. How do they do it? The only way to do it is to buy other companies.
Clive Thompson continues his analysis by discussing the long-term underperformance of gold and silver mining companies, which have lagged behind despite the rise in gold and silver prices over the past decade. Investors have become disillusioned with these mining stocks, which were once overpriced, and have instead funneled their money into sectors showing more immediate returns. The stock market has been on a rapid upward trajectory, drawing funds away from the stagnating gold and silver mining sector. However, Thompson points out a significant reason for optimism in the near term for these mining stocks: mergers and acquisitions. Large gold mining companies are now in an optimal position to acquire smaller, financially constrained competitors that possess substantial gold and silver reserves, but lack the capital to exploit them. These acquisitions are particularly attractive because the price of gold and silver has increased significantly over the last year and a half, making these smaller companies' reserves more valuable and viable to extract. For instance, gold prices that were once hovering around $1,600 per ounce, making many mining projects barely viable, have now surged to around $2,400 per ounce, rendering these projects economically attractive. This increased viability of mining projects translates into a surge in value for smaller mining companies with considerable reserves. Yet their stock prices have not caught up with the actual value of their reserves, presenting a lucrative opportunity for larger mining firms to expand their resource base at a relatively low cost. Thompson mentions that these larger mining companies, already holding significant reserves, are strategically looking to increase their holdings further by acquiring these undervalued competitors. This consolidation in the mining industry not only enhances the larger companies' reserve base, but also streamlines their operations, making the logistics of resource extraction more efficient and cost-effective. This wave of mergers and acquisitions is poised to have a profound impact on the market dynamics of precious metals, particularly silver. As these acquisitions take place, the market will recognize the intrinsic value of these reserves, leading to an increase in the stock prices of both the acquired and acquiring companies. This consolidation will likely result in enhanced production capabilities and efficiency, further boosting the supply of silver to meet the rising industrial demand. The combination of increased industrial demand for silver, coupled with the strategic acquisitions in the mining sector, sets the stage for a significant rise in silver prices. As investors witness the unfolding of these trends, their confidence in the precious metals market will strengthen, driving more investment into silver. This influx of investment, along with the anticipated boost in production and efficiency from consolidated mining operations, supports the prediction that silver prices could potentially skyrocket to $1,000 per ounce. The recent underperformance of mining stocks, juxtaposed with the current surge in precious metal prices and strategic industry consolidation, underscores a pivotal moment for silver. Investors seeking to capitalize on these developments will likely fuel further demand, propelling silver towards unprecedented price levels.
March 2021. So it's been going on non-stop and faster than anyone could have imagined. Every year they come out with their forecasts of where the stock market's going to end up, and it ends up much higher than they forecast. And the reason for that is there's a lot of money out there. I mean, if you think about it, when the government borrows money, the government gets poorer, and someone gets that money, so someone gets richer. Now, it may not be the first person they give it to because they're giving it out as social security or salaries to the government employees, but those people are spending the money on something, and it goes up the value, up the chain until it ends up in the hands of the wealthiest people. Could be big corporations or foreign governments or whatever. But whoever's got that money, looking at the treasury markets, some of them are saying, well, I'm not happy with my 4.5% on treasuries. I actually want to get a bit more. I want something which is more robust, which is going to protect me more against inflation. And that's why they're heading into the equity market. That's why they're heading into gold. That's why they're heading into silver. And of course, we've seen Bitcoin have its massive rise as well, for not necessarily for the same reasons, but it's certainly been a factor. And of course, tangible assets of all kinds are attractive, especially the ones which are rare and hard to get. So if you're an extremely wealthy person who likes to collect properties by the sea and rare works of art and so forth, those kind of things are going through the roof because there's more and more wealthy people who've got more and more money, and they're all bidding against each other for these rare assets. It's not going to affect the price as much for the man in the street, because a lot of what the man in the street consumes are things which are made by robots. And you can increase the supply of a lot of things quite easily without incurring much extra cost. The real costs in production are things like the marketing, like the research, like the transportation, and that sort of thing. But whether you make 10 pizzas with a robot or 100 pizzas with a robot, there's a large component of that manufacturing process which is not done by human hands anymore. And so even if the labor costs rise, maybe that's only 10% of the cost of that particular item. And therefore, if the labor costs go up by 25%, it only increases the cost of the item by 2.5%. That's why the inflation is not reflecting the true level of monetary increase. It's not reflecting the increase in the level of government debt. But as the government borrows more and more, it's getting poorer, and other people are getting richer somewhere, and that's pushing up the stock market.
The likelihood of fewer international buyers of dollars in the coming years is high, partly due to the weaponization of the dollar by the United States. While America's allies will continue to hold treasuries, many countries that are neither enemies nor strong allies of the U.S. may become reluctant to keep large reserves in dollars. The fear that the dollar could be weaponized against them, as it has been against Russia and potentially China, makes holding dollars less appealing. This reluctance will reduce the global demand for U.S. dollars. As international demand wanes, The U.S. Treasury will increasingly rely on domestic investors, such as U.S. pension funds, banks, and money market funds, to fund its deficits. However, this shift is problematic given the U.S. government's growing budget deficit. The deficit is expanding rapidly, causing the national debt to rise at a pace that outstrips economic growth. The debt level has long passed sustainable thresholds, entering what is now an unsustainable territory. Compounding the problem, the rise in American interest rates adds to the burden. Much of the U.S. debt was incurred when interest rates were very low, around 1 to 2%, but as this debt matures, it must be rolled over at much higher current rates, around 4.25% for 10-year bonds. Consequently, the interest the government pays on its debt is increasing swiftly. A few years ago, the interest cost was about 7% of the government's expenditure. This year, it has risen to approximately 14% and is projected to continue climbing into the 20s within the next few years. By the mid-2030s, interest costs could surpass 100% of the government's tax revenue, indicating a severe fiscal imbalance. While the federal government could theoretically have the Federal Reserve print more money to cover these costs, this situation resembles a household whose credit card debt has grown beyond their income, leading banks to cut off further lending. The risk for the Treasury market is that lenders will demand higher interest rates to compensate for increased risk. Eventually, these rates could become unsustainable, forcing the Federal Reserve to intervene by buying government bonds, effectively lending money to the government and further increasing the money supply. This precarious financial situation affects the price of silver significantly. As the Federal Reserve prints more money to cover rising interest costs, inflationary pressures will likely increase. Investors, seeking to protect their wealth from inflation, will turn to tangible assets like silver. The demand for silver will rise as it is seen as a safe haven against currency devaluation. Moreover, with fewer international buyers of U.S. dollars, the dollar's value may weaken, making silver more attractive to both domestic and international investors. Now consider the performance of gold and silver mining companies over the past decade. These companies have underperformed despite the rise in gold and silver prices. Investors have shifted their focus to sectors with more immediate returns, leaving mining stocks stagnant. However, mergers and acquisitions in the mining industry are poised to change this. Large mining companies are in a prime position to acquire smaller, cash-strapped competitors with substantial reserves of gold and silver. These acquisitions are increasingly viable as gold and silver prices rise, making previously unviable projects profitable. The consolidation in the mining industry will enhance production capabilities and efficiency, boosting the supply of silver to meet rising industrial demand. This surge in production, combined with increasing investor demand for silver as a hedge against economic instability and inflation, will drive silver prices higher. The combined effects of strategic acquisitions, rising demand, and economic factors create a perfect storm that supports the prediction of silver prices skyrocketing to $1,000 per ounce.
I think it's likely that over the years which come, there'll be less and less international buyers of dollars, partly because of the weaponization of the dollar. America's allies will still hold treasuries, but there are many, many countries who, they're not an enemy of America, but they're not exactly an ally either. And they think, well, they're weaponizing the dollar against the Russians and maybe the Chinese, and who's next, and maybe we're next. So I think the willingness to hold all of your reserves or a lot of your reserves in dollars is going to go down. And that means that the requirement for the Treasury, the US Treasury, to fund itself will have to come more and more from domestic US investors, i.e. US pension funds, US banks, US money market funds, and those sort of things. And there's going to be an appetite problem at some point because the US government is having to borrow faster and faster to meet their official budget. Their official budget is a budget of a growing deficit, and it's a growing deficit which is growing faster and faster, which causes the level of American debt, the government debt, to rise faster and faster. It's rising against GDP. In other words, the level of debt is rising faster than the economy is growing. And it's quite some time ago, a long, long time ago, past the point where one could say the level of debt is sustainable. We're in unsustainable territory. So that debt is getting bigger, and it's being compounded by the rise in American interest rates, because a lot of the debt, which money they've borrowed, was borrowed 5 or 10 years ago when interest rates were very, very low, 1 or 2%. And some of that's coming to maturity, and quite a lot of it's coming to maturity. And as it matures, it will have to be rolled over at the current rates of interest. If you're talking 10-year bonds, 4.25% at the moment, which is a lot higher than the 2 or 2.5% that they were borrowing at 5 years ago. So what does that mean? It means that the interest the government has to pay on the national debt is rising pretty fast. I haven't got the figures precisely in front of me, but a couple of years ago, the interest cost was about 7% of the expenditure. I think this year it's about 14%, and I think it's set to grow quite rapidly up into the 20s in the next couple of years. By the time we get into the mid-1930s, the interest cost, if all things are equal, is likely to exceed 100% of their tax take. So whilst it's still the government, they can get the Federal Reserve to print unlimited amounts of money. At the end of the day, if this was a family whose credit card debt had interest on it, which was higher than the income the family's earning, it wouldn't take long before the banks would say, we're not going to lend you anymore. And I think that's the risk that we have with the Treasury market. Not that people say, I won't lend you anymore, but certainly when they'll say, there's a higher risk now and I want a higher interest rate. And you get to a point where that interest rate is unacceptable or unsustainable, and then the Federal Reserve will be obliged, I think, or forced or invited to step in and buy those government bonds. In other words, effectively lending the money to the government itself. And where does the Federal Reserve get the money to lend to the government? Well, it has to print it.
As we continue to explore the factors that could drive silver prices to unprecedented heights, let's delve into the impact of the evolving global financial landscape. One significant aspect is the declining appetite for holding U.S. dollars among international investors. This trend is influenced by the increasing weaponization of the dollar by the United States, which has caused concern among many countries. While America's close allies may continue to hold U.S. treasuries, several nations, particularly those that are not staunch allies of the U.S., are rethinking their reserve strategy. The fear is that, just as the dollar has been weaponized against Russia and potentially China, it could be turned against them in the future. As a result, the willingness to hold a significant portion of reserves in dollars is diminishing. This shift means that the U.S. Treasury will have to rely more heavily on domestic investors, including U.S. pension funds, banks, and money market funds, to finance its deficits. However, this increasing reliance on domestic funding sources comes at a time when the U.S. government's budget deficit is growing rapidly. The official budget reflects a deficit that is expanding faster than the economy, leading to a rising national debt that has long surpassed sustainable levels. This unsustainable debt level is further exacerbated by rising interest rates. Much of the debt accumulated over the past decade was financed at very low interest rates, but as these debts mature, they must be refinanced at current higher rates, significantly increasing the government's interest expenses. The interest costs on the national debt have been climbing sharply, with a few years ago accounting for about 7% of government expenditure, rising to around 14% this year, and projected to reach into the 20% range in the coming years. By the mid-2030s, it is anticipated that the interest cost could exceed the government's tax revenue, a scenario that poses severe financial risks. This escalating cost of servicing the debt puts additional pressure on the Federal Reserve to step in and purchase government bonds, essentially printing more money to lend to the government. Such actions increase the money supply and fuel inflationary pressures. In this context, silver becomes an increasingly attractive asset. As inflation rises and the value of the U.S. dollar potentially weakens, investors will seek refuge in tangible assets like silver. The metal's historic role as a hedge against inflation and currency devaluation makes it a preferred choice for preserving wealth. Moreover, the reduction in international demand for U.S. dollars could further weaken the currency, making silver even more appealing. Looking at the broader picture, the performance of gold and silver mining companies adds another layer to this dynamic. Over the past decade, these companies have underperformed, primarily because investors diverted their funds to more rapidly appreciating assets. However, a shift is occurring, with mergers and acquisitions becoming a significant factor. Large mining companies are now in a position to acquire smaller competitors who have substantial reserves but lack the financial strength to exploit them. This consolidation is driven by rising gold and silver prices, which make previously uneconomical mining projects viable. The increased efficiency and production capabilities resulting from these mergers will likely boost the supply of silver, aligning with rising industrial demand. This surge in supply, coupled with increasing investor demand driven by economic instability and inflation fears, sets the stage for a significant rise in silver prices. The factors discussed so far highlight a convergence of economic conditions and strategic industry moves that support the prediction of silver reaching $1,000 per ounce. In our next segment, we will explore another critical aspect of this evolving scenario. The interplay between global economic policies and the strategic shifts in the financial and commodity markets will be examined, shedding light on how these elements further influence silver's price trajectory. Stay tuned as we continue to unravel the complex forces at play and provide a comprehensive analysis of the factors driving silver towards this remarkable milestone.
These things continue until they don't. One thing which will always stick in my mind is 1994, when stock markets looked overpriced. They looked like it was due for a large correction. That I can't remember what was happening with the dollar, but something was going on with the dollar. Maybe interest rates were rising. That's what it was in America. So everyone was pretty bearish in 1994 because stocks were overpriced. And yet they went on to have one of the biggest and longest rallies in all of history, certainly the longest I've seen in my lifetime, which lasted until 2006, 6.5 years. So they went from overpriced to overpriced to overpriced to overpriced to extremely overpriced to outrageously overpriced before it finally popped. So this can happen again. And we mustn't forget that we're now in a very different world from 1994, where there were actually humans who could look at these things and say it's overvalued. I do remember cutting out and sending to my clients back then cuttings from the Wall Street Journal, which said, this is crazy. How crazy can it get? These new companies are popping with .coms and so forth. They're popping up like mushrooms in the night. And how can they possibly survive? It's how ridiculous it is. You had the clients all clamoring on the phone to get the next .com. That was then. But where are we now? This is all done by robots. So about 80%, they say, of the trading on the stock market is done by robots, not by humans. And those robots aren't thinking. They're just saying, if it's in the index, we buy it. So when, for example, someone says, you'd like to invest some money, and your banker rings you up and he says, well, I've got this really good fund, but you can also buy some Nivea. You'd probably say, no, I'm not going to buy Nivea, it's too high, I missed the boat. But what's this fund? And he'll say, it's a really good fund, it's gone up by 10%, it's run by a really good firm. You say, great, I'll have some of that. That sounds like a good idea because it's beaten all the other funds. But that fund owns exactly the same stocks that you didn't have the guts to buy in the first place because they were too high. So what happens? The fund gets your cash, the fund piles into those stocks, and the fund has to do it because it's not even thinking about it. It might be an ETF, for example, where it has to follow the index. So that's what's pushing the stocks up, and that's going to continue to push up stocks as long as there's confidence in the public at large to keep putting money into funds and taking it out of their money market funds and putting it to work in that kind of way. And the more people worry about the level of government debt, the more they worry about the inflation rate, the more they're going to look for those kind of inflation hedges. So yes, it can continue for a long time, but we mustn't forget the world is also full of surprises.
These market trends continue until they don't. A significant historical parallel that sticks out is 1994. Back then, stock markets were deemed overpriced, interest rates in the U.S. were rising, and there was a prevailing bearish sentiment. Despite this, the market defied expectations and embarked on one of the longest rallies in history, extending until 2000. This period of extraordinary overvaluation eventually culminated in a significant correction, but it showcased how markets can persist in seemingly irrational states for extended periods. Drawing from this historical context, we'd find ourselves in a new era where market dynamics have evolved significantly. Unlike the 1990s, today's trading landscape is dominated by automated systems. It's estimated that about 80% of stock market trading is now conducted by robots, not humans. These algorithms operate without human judgment, buying stocks included in indices purely based on their inclusion, regardless of valuation concerns. This mechanistic approach means that as long as funds continue to flow into these automated systems, the stocks they target will keep rising. Consider this scenario. When you approach a financial advisor or a bank to invest your money, you might be presented with a high-performing fund. You may hesitate to buy individual stocks like Nvidia due to high prices, but the fund you invest in owns those same high-priced stocks. As more money pours into these funds, they are compelled to buy more of these stocks, further driving up their prices. This self-reinforcing cycle can sustain stock price increases as long as public confidence in investment flows remain robust. However, underlying these market dynamics are growing concerns about government debt levels and inflation. As these worries intensify, investors will increasingly seek out inflation hedges. This brings us back to the allure of tangible assets like silver. As confidence in traditional financial instruments wanes, the attractiveness of assets that can preserve value, such as silver, grows. The current global economic environment, characterized by high debt levels and inflationary pressures, sets the stage for a surge in demand for silver. Investors, wary of the sustainability of government debt and the devaluation of currencies, will turn to silver as a reliable store of value. This shift in investment strategy is likely to drive up silver prices significantly. So, while automated trading and fund flows continue to push stock prices higher, the underlying economic realities are steering savvy investors towards silver. This convergence of factors, market mechanics, rising debt, and inflation concerns, creates a perfect storm that could propel silver prices to unprecedented levels. In our next segment, we will explore how the geopolitical landscape and the shifting allegiances of international investors are further influencing the demand for silver. Stay tuned as we continue to uncover the multifaceted forces driving silver towards the remarkable milestone of $1,000 per ounce.
Yes, just give me a second. I think I can bring up a slide to share with you. We're looking here at a chart over the last decade of the amount of silver which has been mined, and that is the green line, which is sloping gradually downwards, and it's in millions of ounces. So it's gone down from about 950 in 2015 to from about 900 million ounces a year being mined to the current just over 800 million ounces a year being mined. So the amount of silver being mined is dropping a little bit each year. And then we've got the blue line, which shows the consumption of silver for uses like electronics and so forth, the normal uses of silver, not including the manufacture of silver coins or silver bars. It's basically the manufacture of any industrial use, whatever it may be. And we see that back in 2015, it was around 750 million ounces being used compared with the 900 million being mined. So they had less being used than mined. And if we step forward to the year 2022, that was the first year in which the amount of silver being consumed by the industry exceeded the amount being mined. And 2023, the amount being consumed went up a lot. And the reason for that in 2023 was the electronics industry consumed an extra 20% of silver compared with the year before. And the subcomponent of electronics industry is the photovoltaic area, which consumed, I think it was 67% more silver in the year. And those numbers are set to continue, at least according to the forecast from the Silver Institute, so much so that the small gap which we had in 2022 became a slightly larger gap in 2023 and will become a very large gap next year or this year, if you like, according to their forecast, 2024. And it's going to, the gap, or the shortage of silver, if you like, is going to continue getting wider as far out as the eye can see.
Let's dive into the current dynamics affecting the silver market, focusing on production and consumption trends. Over the past decade, we've observed a steady decline in silver mining output. This decline is represented by a green line on our chart, which shows a decrease from approximately 950 million ounces in 2015 to just over 800 million ounces in recent years. This downward trend in mining output indicates a shrinking supply of newly mined silver. In contrast, the consumption of silver has been steadily increasing, especially in industrial applications. The blue line on the chart highlights this rise, showing that back in 2015, around 750 million ounces of silver were used for various industrial purposes, excluding the manufacture of silver coins and bars. By 2022, we reached a pivotal moment where industrial consumption exceeded the amount of silver being mined. This trend continued into 2023, driven largely by a significant uptick in demand from the electronics industry, which saw a 20% increase in silver usage compared to the previous year. One of the most notable areas of growth within the electronics sector has been the photovoltaic industry, which consumed 6 to 7% more silver in 2023 than in the previous year. This surge in demand is expected to continue, further widening the gap between silver supply and demand. Forecasts from silver industry institutions predict that this shortage will only grow in the coming years, creating a persistent and expanding deficit. The implications of this supply-demand imbalance are profound for the silver market. As the gap between mining output and industrial consumption widens, the scarcity of silver will likely drive prices higher. This scenario is compounded by the overall economic and geopolitical factors we've discussed earlier. With global economic uncertainties and increasing investor demand for safe haven assets, the pressure on silver prices is set to intensify. To put this in perspective, consider the historical context of commodity markets. When demand outstrips supply consistently, prices are driven upward, sometimes dramatically. The silver market is now entering such a phase, where the fundamental supply constraints and burgeoning demand create a perfect storm for price escalation. As we continue to analyze the silver market, it is essential to understand that these trends are not isolated. They interact with broader economic forces, including inflationary pressures, rising national debts, and shifting investor preferences. These factors collectively support the argument that silver could reach unprecedented price levels. In our next segment, we will delve into how the weaponization of the dollar and geopolitical shifts are influencing international investors' behavior, further impacting the silver market. Stay tuned as we explore the intricate web of factors driving silver towards the remarkable milestone of $1,000 per ounce.
The reason for that is we're not going to have less electronics on the planet. We're not going to have less photovoltaic on the planet. So just talking about photovoltaic, that's people often think about solar panels on your roof. But it's not just that. There are so many household items and other items which have got photovoltaic cells now, ranging from battery chargers to Internet of Things devices. Almost everywhere you look, you can see these solar panels, security cameras. So there's more and more of them going into electronic devices. And that's consuming a lot of silver and pushing up the consumption of silver. So that's not going to go away. Will the supply of silver increase? It could do, but it's not going to be very fast because most of the silver is mined as a byproduct of other metals. And when you're opening up a pure silver mine, it can take a number of years. So that downwards trend in the mine production of silver is probably going to continue along those lines for a while. And the upward trend in consumption is likely to continue. So if you can see the chart, the blue line heading upwards, we are already well ahead in terms of the shortage getting bigger and bigger, and it's going to get bigger and bigger. Now, the difference between the shortage of silver, where is that supplied from? It's supplied from recycling. But the way you get recycling is you've got to have a higher price to get your granny to take her candlesticks down to the pawn shop and have them melted down. I don't. I'm certainly not going to be taking my silver coins to the coin shop and having them melted down, but some people might be if they're desperate for the cash. But the higher it goes, the higher the price goes, the more likely they'll do that. So to get that silver, to meet that shortage, there's got to be more recycled silver, which in my mind means that the silver price probably over the next few years will probably head upwards. How high could it go? Well, the previous peak was $50. It's below $30 as I speak. I think that it could easily go past the previous peak, probably not this year, but certainly in the next year or so, maybe 2 years, 3 years, that peak of 50 could be passed. That's not advice. It's just my personal opinion, because when you have a shortage of something, the price has to go higher to either reduce the demand or increase the supply. And I think that's what's going to happen here.
To wrap up our in-depth analysis, let's tie together all the threads we've discussed and explain why these factors are leading us towards a silver price of $1,000 per ounce. Firstly, we've seen how rising U.S. interest rates have put pressure on international investors, particularly Japanese banks, to unwind their positions in U.S. treasuries. This movement away from U.S. assets is causing significant shifts in global financial markets. As investors seek safer havens, silver, a traditional store of value, becomes increasingly attractive. Next, the disillusionment with gold and silver mining companies has led to a period of underperformance for these stocks, despite rising precious metal prices. However, the landscape is changing with an uptick in mergers and acquisitions in the mining sector. Large mining companies are snapping up smaller competitors to boost their reserves, driven by higher precious metal prices and the viability of previously unprofitable mining operations at these elevated prices. This consolidation trend is set to enhance production efficiency and potentially increase supply, but it will take time to materialize, adding further pressure on silver prices in the short term. Additionally, the weaponization of the U.S. dollar has made international investors wary of holding too many dollar-denominated assets. With the U.S. government's increasing debt levels and the corresponding rise in interest payments, the sustainability of this debt is in question. As more investors turn to alternative assets, silver stands out due to its historical role as a hedge against economic instability. We've also seen how speculative and automated trading has pushed stock prices to new heights, even in the face of economic fundamentals suggesting caution. This speculative behavior underscores the potential for significant price movements in commodities like silver, which are becoming increasingly scarce relative to demand. The supply-demand dynamics for silver are stark. Silver mining output has been declining, while industrial demand, particularly from the electronics and photovoltaic sectors, is surging. As the use of photovoltaic cells expands beyond traditional solar panels to a myriad of electronic devices, the consumption of silver continues to rise. This trend is unlikely to reverse given the growing importance of renewable energy and advanced electronics in our daily lives. Moreover, the only way to address the widening gap between silver supply and demand is through recycling, which requires higher prices to incentivize the recovery of silver from old products. As silver prices rise, more recycled silver will enter the market, but this process will lag behind immediate demand needs, pushing prices higher in the interim. Given all these factors, it's plausible that silver could surpass its historical peak of $50 per ounce in the near future. However, looking further ahead, the combined effects of reduced supply, increased industrial demand, and the broader economic shifts we discussed suggest that silver has the potential to reach extraordinary new highs. The notion of silver hitting $1,000 per ounce might seem far-fetched, but when we consider the unprecedented economic environment, the substantial increase in industrial uses for silver, and the shifting investment strategies driven by geopolitical and financial instability, it becomes a more tangible possibility. Remember, this analysis is based on current trends and available data. Investing in commodities always carries risks, and it's crucial to conduct thorough research and consider professional financial advice before making any investment decisions. If you enjoyed this deep dive into the silver market and want to stay updated on the latest financial insights, don't forget to subscribe to our channel. And remember, this video is for informational purposes only and does not constitute financial or investment advice.